Very good morning to everyone. Wednesday the 6th of September. Hope you all had a good evening. Just going straight into things, and one of the main observations on the charts here is the move that occurred after, I would imagine, a lot of people would have left for the day. So after the European cash close at 4:30, where we had some negativity developing up until the close in Europe, but really it was after that point, and very quickly after, we broke a significant technical level, that being the initial gap low that we had following the resumption of trade for this week after the nuclear test from North Korea. And we broke that, and then the selling pressure really started to take hold in this S&P. Looking here, slightly longer dated, you had that high on the 25th and the 30th. That also getting broke, and then we went all the way down to a low point at 24.45.5 before then recovering very quickly. And then if you look at where we are this morning, we are in fact have retraced pretty much all of that sell-off. So really roller coaster moves that we're seeing in yesterday's session. You can see here defined by that large wick. Put it on a 30-minute here. So this was the level that broke after European trade, and to where we are at the moment, having recovered all of that move. So that equity sell-off, though, certainly helped the risk-off sentiment. You can see here T-notes, really that trend that materialized through when the US came back into market, reacting to a couple of different things. It wasn't just the North Korea reaction. And we'll look at some of the other things that have occurred. But T-notes, you can see a really strong move. And if we'll look at federal funds rate futures, the pricing of a December Fed rate hike has dropped about 10% from where it was only about 24 hours ago. So it's dropped from basically 40 to 30% probability of a 25 basis point hike. Consequently, gold remains elevated. The Japanese yen remained stronger yesterday. And so that kind of flight to quality bid that we've become accustomed to during various points of reaction to the Korean situation kind of returned. Now, there were a couple of other things that people were looking at. For one, you had some dovish Fed speak. Brainard in particular drew some attention. You also had the looming debt ceiling. Obviously, the summer recess is now over, and so politicians have returned to Capitol Hill, but there still is the issue looming large and needs to be resolved, obviously, ahead of really October. Before then, there could be the risk of a government shutdown. You had the decision to end the DACA program. Not sure if you guys have heard of that before, but that's the Deferred Action for Childhood Arrivals in the US. Now that affects roughly 800,000 people, and it's to do with temporary legal immigration status for the young, essentially. This was put in place by Obama back in 2012, but the Republicans have basically want to throw it out and remove the current program and replace it with something else, an alternative. What this means then is that some analysts have been talking about the risk that because the Democrats will want an alternative brought forward rather than it being left in a limbo, might they then refuse to sign off the agreement on the debt ceiling in order to then get the Republicans to agree on some sort of happy medium on the replacement for that immigration status program. So again, it doesn't sound like much, the decision to end that DACA program, but it does have ramifications then, potentially, for the debt ceiling. And so hence then, could have been another negative catalyst that people were looking at yesterday. The other big thing, of course, is now another hurricane. So Hurricane Irma has Florida bracing for the Atlantic's most powerful storm yet. And we'll have a look at that in a second. Other things are obviously looming in the background. There's Brexit. There was talk of a Guardian article yesterday that was in circulation. They were talking about Britain will end the free movement of labour immediately after Brexit and bring in restrictions to deter all but only highly skilled EU workers. You've got the talk about breaking up of NAFTA, Trump-Russia investigations ongoing. So most people are looking at a kind of a multitude of different reasons to pin on the sudden move lower that we had in equity markets that prompted then this risk-off trade in the US hours after we had left yesterday afternoon. I wouldn't say there was one single headline. Obviously on the Korean front, we did have President Trump tweet earlier in the day that allowing Japan and South Korea to buy substantially increased amount of highly sophisticated military equipment from the US. There was also reports that North Korea is preparing to launch a missile test before Saturday. And at the same time, Vladimir Putin rejected calls for new sanctions on North Korea. So basically highlighting, ahead of a key UN meeting upcoming, a bit of a fraction between the global powers on how they want to deal with this particular Korean issue. So all of these you could put together to create this kind of negative turn in sentiment that we had. Now, one of the things here that we're looking at in regards to the hurricane that's developing at the moment and set to hit the southernmost tip of the state of Florida in the United States, there's a lot of people looking at this for the ramification of cost. So Barclays, this is one that Bloomberg are talking about a lot this morning. Essentially, Barclays are estimating the insured losses in a worst case scenario could be $130 billion on the back of this particular storm. Don't forget, we're talking about roughly a similar size number for Hurricane Harvey and the area of Texas. And so combined, you've almost got a $250 billion impact here. Now, this really means two things that have been in focus. Natural gas slid, speculation the storm will wipe out demand for power plant fuel. However, on the opposite side, this is orange juice futures. Quite like the Bloomberg pun here. Orange prices juiced. It was the best up move that we've seen in OJ in about 16 months. Obviously, geographically, much of the orange juice production, I think Florida is the second highest, presumably. I can only imagine that's probably after California. But it's most of that crop, if you like, comes from the southern tip of where directly by Sunday the hurricane is expected to hit landfall in Florida. So OJ has already been pricing this in. You can see this wasn't just yesterday. This has been building up really since Thursday last week. It's only now that we're getting closer and so the trajectory of the storm is getting more accurate that prices have started to soar yesterday. On the flip side though, one thing that makes equities weaken is check out the performance of some of the insurance companies. I think they might have it on here. So insurance provider XL Group, so these are US listed firms, they dropped 5.8%. Everest dropped 6.9%. Universal Insurance Holdings, which sells more homeowners coverage in Florida than any other carrier, plunged 15%. If you think about it then, if we're talking about some $250 billion worth of potential damage that this could have, and insured losses for this one storm alone could be 130 billion, then insurers, were the big short, which led a lot of the sector sell-off in the equity market yesterday. So that might explain why some of the catalyst was that. So one interesting point here though is we have recovered and the market's managed to kind of pause for breath. The S&P, as I said, has already taken back a large portion of that move, and in fact that level of key significance we were looking at from the gap down at the beginning of the week, we're now back above that key point. Now that's been quite a key level, not only for the break, but if you look at the recovery we had yesterday, that then acted that previous support as resistance. We hit it just before the close, and it contained some of the Asia Pac movement. Before then we've moved above that as Europe stepped back into the market. Interestingly, the DAX moving back on the upside albeit futures still in slight negative territory. So coming back in towards pivot as the first kind of barrier short term here. Looking at some other things to be aware of from this morning. And firstly, before I start talking about Brexit, I wanted to mention the Fed, because one thing we've heard here, and as the headline would suggest, policymakers signal caution on inflation and rate hikes. Let me just transition my screen. So this is the Reuters headline article that they're going with this morning, and what they're looking at here is the Federal Reserve is getting more dovish in the face of weak inflation, reducing the likelihood of a third rate hike this year, which traders already see as very unlikely. As we know, the market pricing is considerably lower than the 50% required for it to be hypothetically priced in by expectations. 3 Fed policymakers just yesterday expressed doubts about further rate hikes, with one influential policymaker calling for a delay in raising US interest rates until the Fed is confident inflation will rebound. So the 3 that they're talking about here are, in particular, Brainard, Kashkari and Kaplan. So let me just recap for you the 2 major speakers and what they said. So Brainard, in a speech in New York, she said, "My own view is that we should be cautious about tightening policy further until we are confident inflation is on track to achieve our target." Kashkari spoke later in the evening, so if you didn't catch his speech, he followed up with also similarly dovish comments, saying it's very possible that our rate hikes over the past 18 months are leading to slower job growth, leaving more people on the sidelines, leading to lower wage growth and leading to lower inflation and inflation expectations. I mean, it doesn't get much more dovish than that. The only thing I'd say, the caveat here, is that both are typically dovish. So it's not massively surprising, but I would say there's a growing chorus amongst some of these members where this inflation moving further from target is becoming more of a greater concern. It does mean then that any other more neutral or indeed more hawkish leaning Federal Reserve speakers I would be watching with great interest going forward to see whether or not it's more important, have they been swayed by this lower inflation situation to start pulling off this kind of communication line of tightening the balance sheet upcoming in the next month, and then the final rate hike, which they've said, remember, their original projection when issued back in December of 2016 that they were going to do 3 this year. We're in September now, 9 months in, and they've managed to execute that plan successfully so far, i.e. they've done 2, and most would expect the 3rd to come in December. The question is, can they continue to follow that through? So I think maybe, again, adding to some negativity, although the comments were dovish and that would typically support equities, maybe it's the fact that the obviously question marks are arising on more uncertainty over the future of federal policy, which maybe makes some participants feel a little bit nervous. This is what the federal funds futures look like then. This is the pricing in the short end of the curve for an interest rate hike in the month of December. So as I said, this was roughly, I think when we looked at it last time, at the beginning of the week, this is when we first came in, this was up at about 42%. It's now dropped to 31.3% likelihood of a 25 basis point rate hike in December. Okay, some other headlines to be aware of. This is probably one you might have read about. This is about Theresa May's Brexit planning, suffering a double blow as a top European official doubted that trade talks will start next month, and the opposition Labour Party prepared to challenge key legislation. This all comes as well after an 82-page document obtained by The Guardian last night said that immigration should not just benefit the migrants but make existing residents better off. It's basically talking about only having more highly skilled migrants as part of this new deal that they're trying to fathom at the moment. So ending free movement of labour immediately after Brexit and bringing restrictions to deter all but highly skilled EU workers. So obviously this is going to come under a large amount of pressure, I'm sure, from the opposition Labour Party. Don't forget, then they're back from their summer holidays now, the UK politicians. So today, of course, is Wednesday, so they're going to be having the normal PMQs from about midday later on today. Be very interesting to see how Theresa May performs this afternoon. How's this translated into anything in terms of movement for the pound? Well, no. I would say this is kind of not that surprising. There's a key speech that Theresa May is said to be delivering. I don't think it's been finalised as yet, but most are predicting about the 21st of September. This obviously then is about a week ahead of the Tory party conference, which is happening between the 1st and the 4th of October. So I'm pretty sure she will want to appear pretty stern along the hard Brexit mandate in order to appease her fellow Conservative members. So I don't think the market really is expecting none other than this type of rhetoric between now and then. And as such, then pretty minimal reaction being seen in the sterling currency at the moment. Wrapping up a few of the other headlines from overnight. This might be another thing just to be aware of for any FX traders. I know some of you do trade the Aussie currency. Aussie's seen slight negative territory, trading just below pivot at the moment. Australia's economy expands, but at a slower pace than forecast, and did put some downside pressure on the currency overnight. Whereas in Europe, I think it's really the only major data we have out of the Eurozone this morning. Came out of Germany at 7 a.m. this morning. That was industrial orders. Unexpectedly declined 0.7%. Market consensus was for plus 0.1%. So it missed by 0.8%, which is fairly large, but on a historical basis, we were tracking quite a bit lower than this only back in April. So hence the reason why, if you're looking at the DAX, the Euro, the Bund, there's been very little, if not any, reaction to that specific data. Okay, calendar, as I said this morning, relatively quiet, but going ahead, mortgage application data, this is kind of from a trading perspective, a non-event, doesn't ever move the market in this current economic environment. But we do have US trade balance coming at 130. We'll get the Canadian equivalent as well at the same time. Going further forward, you then get the market service PMI figure coming out of the US at 245, but bear in mind this is a final reading. The emphasis here will be on the ISM non-manufacturing number, and that comes at 3 p.m. So your major US economic data of the day is at 3 p.m. Just having a quick look at what the ISM non-manufacturing PMI statistic looked like last month. Well, actually, it came in at 53.9. This was one of the big surprises last month because expectations were for 57. So expectations were basically for this chart here, if I show you the numbers, to continue to track up and around the most elevated levels we've been in the last 12 months. However, it surprisingly dropped fairly substantially down to levels not seen since August of 2016. Production, new orders and employment eased while price pressures increased. So looking at the median consensus today, let's see if they have one. Okay, 55.3 is what the consensus is. So we are looking for a bit of a bounce back. But just given the weakness of that number, given some of the fragility that we're hearing over the area of specifically inflation, if other areas of the economy start to soften as well, you can expect then this more dovish rhetoric from Fed members to continue. Going back, the other big thing, this is more for currency traders and for the guys looking in FX, you've got the Bank of Canada, the BOC rate decision. Now, here's a preview. I'll pop this in the chat when I've concluded this briefing. But in a nutshell here, the majority expect the central bank to leave its overnight rate unchanged at 0.75%. So only 6 of 33 surveyed expect the BOC to hike this time out. So the broader expectation on the street, if you like, is that overwhelmingly pretty much that we're not going to see any change in rates. However, with Canada, the important thing here is they release their what's called an MPR, which is a monetary policy report. They release this on a quarterly basis. Not only is this a summary of economic conditions, it also gives you this projections for the Canadian economy, inflation and GDP, much like a quarterly inflation report we have in the Bank of England or the summary of economic projections for the Fed. This is kind of the Canadian equivalent. So regardless of the fact that most will expect that interest rates to be left on hold, actually it will be the ensuing comments and statistics on their forecast going forward that inevitably will create a highly volatile situation for the Canadian currency. So that could definitely offer up some opportunity when that event happens. Again, that's at 3 p.m. And then finally, just owning to the Labor Day holidays on Monday, remember the oil inventory numbers, the APIs are this evening, the DOEs are not until Thursday because of that holiday. And that's pretty much it. So going to leave it at that. Any questions you might have, please do feel free to put them in the chat. Otherwise, have a really good day. Thank you very much.